So, today in Tech Sutra Conclave, we did discuss about the tax aspects of the business restructuring, including merger and acquisition. And I spoke that for any business restructuring, tax aspect plays a very key and pivotal role in determining the in taking any decisions. So, it actually depends upon what is the objective of the transaction and whether you are actually advising the buyer or the seller. There are various modes in which the business can be acquired. So, it could be merger or the share purchase if you want to acquire the entire company, or it could be a demerger or the slump sale if you want to acquire a specific business. The itemized purchase of assets is resorted to only when you are acquiring a specific asset. When you look at the merger or the share purchase, there are different facets and advantages, disadvantages which a merger as compared to share purchase would have. So, when you look at merger is a cashless and most tax efficient way of acquiring the business. There are advantages with respect to the company. The transferor company does not pay any tax. Similarly, in the hands of the shareholders, they do not pay any tax for the shares which they receive of the transferee company. Apart from this, there is also a huge advantage in terms of benefit of unabsorbed loss and depreciation which a transferee company could avail of. So, all these factors one needs to take into consideration, but amalgamation is a time consuming and cumbersome process, and it involves taking approval from the court, which may sometimes could act as a stumbling block. As against that, the transaction of purchase of shares is much more simpler and easier, and by acquiring the shares you could still achieve the same objective which through an amalgamation you could achieve. Apart from that, by purchase of shares you could also look at the treaty benefit, where if you are coming from a tax haven, then you do not end up paying any tax in India. Of course, this is all subject to the provisions of the BEPS and the GAR, which are going to be kicking in from 1st April 2017. So, your transaction structure has to meet the BEPS and the GAR regime. If you look at if you are looking at only a specific business undertaking you want to acquire, then perhaps you could look at a demerger or the business purchase on a slump sale basis, where you do not acquire the entire company. So, of course, demerger is also a court driven process, but you enjoy the equal advantage of tax saving in the hands of the demerged entity as well as in the hands of the shareholders of the demerged entity. But again, demerger is also a court driven process, and it will take its own time, just like a merger. As compared to that, if you look at a slump sale, it is very easy method or mode of acquiring a business, and you also get the benefit of the step up cost, whereby you could allocate the purchase consideration over the various assets which you have acquired from the transferor, and you could also possibly record some goodwill on which you can claim the depreciation. From the seller's perspective, the consideration is received by the company, and if the seller wants cash in their hand, they may end up paying the dividend distribution tax. So, it may not be that much advantageous from the seller's perspective vis-a-vis sale of shares. So, all these different aspects one need to take into consideration. There is one more angle of non-compete fees. So, generally in all type of transaction, the promoter of the transferor company agrees to join the business of the transferee company, and the transferee company agrees to pay some non-compete fees to the promoter of the transferor company. The tax aspects around the non-compete fees also play a very important role, both in the hands of the payer as well as in the hands of the payee. So, in the hands of the payee, now the law has been very clear that it will be regarded as a revenue receipts and will be chargeable to tax. As far as the payer is concerned, whether that non-compete fees would be allowed as a deduction is a dispute which has been going on for quite some time, and the courts have been holding it either as a revenue expenditure or capital expenditure depending upon the terms of the agreement. Again, if the same has been held as a capital expenditure, whether such non-compete fees would be eligible for depreciation is again a bone of contention, and different high courts have been taking a different view. For example, Chennai High Court in the case of Pentasoft and Karnataka High Court in the case of Ingersoll Run have allowed depreciation on the non-compete fees, whereas the Delhi High Court in the case of Sharp Business has disallowed the depreciation. So, one needs to evaluate where the transaction is being carried out. Apart from direct tax, stamp duty also play a very important role. So, the order of the High Court is actually considered as the conveyance, and accordingly the stamp duty would be applicable on such order of the High Court. And generally the stamp duty is payable on the value of shares which are being exchanged in the course of the amalgamation, or it could also depend upon the immovable property which is being transferred by the amalgamating company. Also, indirect tax also plays a very pivotal role. The transactions which are carried out between the transferor and transferee company in the intervening period, that is between the appointed date and the effective date, whether it would entail payment of VAT or the service tax, again would depend upon from state to state, because the indirect tax is a state subject. For example, in Maharashtra, they have made the law that the transactions which has been carried out between the appointed date and the effective date would be regarded as a transaction carried out between two separate independent entities, and on that the VAT would apply. So, all these aspects assumes great importance before any decision on the business restructuring transaction is taken. Apart from that, there are provisions with respect to indirect transfer, where the shares held in a foreign company is deemed to be situated in India if such shares derives its value substantially from the assets situated in India and the value of the Indian asset is more than 10 crore. So, because of the globalization, lot of transaction is taking place outside India, but it may be holding the assets in India through layers of the subsidiaries, and in such situation one would have to be mindful of these particular provisions. The provision, the way it has been drafted, are quite complex and cumbersome, and there are several procedural requirements which are also specified in Rule 114 DB. So, for the Indian company, there is an onerous requirement in terms of reporting of this particular transaction. They need to submit form number 49D, in which they need to capture several information with respect to its ultimate holding company, the intermediate holding company, and its immediate holding company. They need to capture the information of the shareholding pattern of the transferor company before pre-transfer as well as the post-transfer. They have to give information with respect to the finance of that particular company and how did they carry out the valuation. They need to also provide the valuation of the Indian company. So, there are whole host of requirement which the Indian company is required to report and maintain the documentation in this regard. So, as I mentioned, there are several direct tax aspect, there are indirect tax aspect, stamp duty aspect. So, one need to evaluate all these aspects before arriving at the final conclusion. And to sum up or to conclude, not only these aspects need to be taken into consideration, but the impending provisions of GAR, the evolving provision with respect to BEPS, and the softer aspects of the integration between the two companies, how the employees would gel with each other, the cultural differences, all these aspects need to be taken into consideration. In case of a listed entity, you need to take into consideration the takeover code, the competition act, and the exchange control regulations. So, as you could see that there are a whole host of the provisions which would come into play, and it requires a good team to look into the several aspects before zeroing on a particular option. Thank you very much.